Alcoa kicks off earnings season on Wednesday, but perhaps more important than its second quarter results will be the company's long-term outlook. I'm joined by Andrew Lane, equity analyst at Morningstar. Andrew, there will be a focus on Alcoa's long-term outlook as the company transitions from being aluminum-focused to a broader specialized metals firm. How do you believe the company's transition is progressing?
Yeah, hi, thank you for having me. I think the portfolio transformation is really progressing nicely, and we'll get a good glimpse as to how quickly or how rapidly the transformation is moving forward in this second quarter. What we really like about the company's decision to close some of its high-cost aluminum smelting capacity and invest downstream to increase its aerospace exposure is that we think that downstream aerospace exposure is really a moatier business. Through its recent acquisitions of Firth Rixson and RTI International Metals, the company produces a lot of product lines that face the aerospace industry. And what's really interesting to us about this exposure is that these product lines have a very high cost of failure, but they represent a very small cost in terms of the total cost structure of manufacturing a commercial aircraft. And so through that dynamic, we think Alcoa can enjoy the generation of economic rent, and we think therefore, it's a much moatier space for them to operate in.
So as the company closes those high-cost smelters that you mentioned and increases its focus on aerospace and meeting automotive demand, it still does face a volatile aluminum pricing environment. How much of a headwind does that remain?
It remains a major headwind. I would argue that the company is better positioned to weather a decline in the all-in aluminum price now than it really ever has been before, particularly relative to even just a year ago. So the company's done a few things to improve its positioning on the aluminum smelting cost curve. First of all, it has cut a great deal of high-cost capacity. It's closed 25% of its smelting capacity since the beginning of 2013 alone, and most of that is high-cost capacity. So it's moved a little bit down the cost curve in that sense, but additionally, it's ramped up production at a joint venture in Saudi Arabia with the Ma'aden mining company that's believed to be the lowest cost smelting facility in the world. So through the curtailment of high cost capacity and the addition of new low cost capacity, we think the company's unit costs for smelting have fallen about $200 per metric ton since 2013 alone. So certainly, although a lower all-in aluminum price will weigh heavily on the company's second quarter earnings, we think the company is fairly well positioned to digest that down cycle. And as the downstream investments pay off, they should offset some of the weight or some of the negative impact of the aluminum down cycle.
So what do you believe the key aspects of this report will be? What do you believe investors will be listening for?
Yeah, I think there are really a couple key things that investors should be listening for. The first is really just how effective has the company been in cutting costs for their upstream exposure. As I mentioned, unit costs in the smelting business have declined significantly. But will the company maintain a positive operating income in the primary metal segment? They should be relatively flat. But if they've been even more effective in cutting costs than investors anticipated, that could bode well for shares, given that the impact of lower aluminum prices, in my view, has already largely been priced in. And then secondly, with the tablecloth being pulled out under the aluminum commodity side of the business, how much progress has the company made in their downstream investments? Will the engineered products and solutions business that has that aerospace exposure come to the rescue, or are we still a few quarters away from that particular business line really generating significant earnings growth for the company? In my view, the upstream results will likely disappoint to some degree, but through the integration of their Firth Rixson acquisition, the company is on pace to generate the highest operating income result for the engineered products and solutions business in company history. And so I think this quarter will indicate that their transformation downstream is well underway.
Thank you so much, Andrew Lane, equity analyst at Morningstar.
Thank you for having me.
And I'm Brittany Umar for The Street.